So that recession everyone was worried about earlier this year?
We're in a scenario where we have a stagflationary environment. I think the economy is going to cool off. I think we'll have a recession by the end of this year or the beginning of next year, and we'll still have rising food prices and rising energy prices. And unfortunately, the Fed's monetary policy just can't change that.
I think the market has been pricing a recession since the beginning of the year.
And then began worrying about it again?
But our base case is that the U.S. economy will go into a recession by the middle of next year.
Turns out that recession everyone was worried about has finally arrived. But right now, it's only for America's rich. Sticky inflation and a weakened stock market continue to disproportionately pressure wealthy Americans as more and more high-income earners file unemployment claims, according to Bank of America's August 2023 Consumer Checkpoint Survey.
The biggest engine for wealth creation in the world, the driver of wealth, is the stock market. It is also the driver of wealth destruction.
So why should we care about this so-called recession? Because of something called the wealth effect. That's when the declining value of financial assets leads to a decline in consumption. And since the U.S. economy relies on consumer activity for most of its growth, fewer people buying fewer things can lead to a stagnant economy. Here's why the long-awaited recession has arrived for America's rich and why it matters for everyone else.
"2022 was a year where the stock market was down very sharply, and we started to see home prices turn south, particularly in some of those hot markets where tech jobs, had helped drive those prices up. As the tech sector cooled, you started to see prices fall. So that had a pronounced impact on the net worth of a lot of households in 2022. Some of that has come back in 2023 as markets have rebounded, not quite to the record levels seen at the beginning of 2022, but a hearty rebound nonetheless.
2023 saw a slight bull rally during the summer, despite rate hikes, thanks to a strong and resilient consumer.
A lot of the hurdles that were in place in January are still in place right now. It's not as if we've seen some sort of super positive reinforcement of this is why we can get rid of that sort of uncertainty and replace it with certainty.
Regardless of the country's economic standing, many Americans are feeling the pain of inflation and the cost of revenge spending, as even the wealthy are exhausting their savings and are leaning on credit cards to remain afloat in a tough economy. Companies' recession fears have stonewalled the white-collar job market. Listings compared from a year ago today show a nearly 40% drop in banking and finance jobs and a 50% drop in tech roles.
Thousands more are being laid off in the tech sector. Microsoft is cutting 10,000 jobs, and Google's parent, Alphabet, is reducing its headcount by 12,000 jobs. That follows other hefty job cut announcements from Amazon and Salesforce earlier this month.
The headline here is that any bank not led by Jamie Dimon has been cutting jobs this year. If you look at the big six banks who've all reported, Wells Fargo is the biggest sort of perpetrator here. They've cut about 11,000 jobs, or about 5% of their workforce, just this year alone. And you look at another one, and that's, apart from Wells Fargo, there's also Goldman Sachs. And both of these institutions have had these, businesses that are hit into the wall of high interest rates.
UBS's 2023 Global Wealth Report found that America lost 1.8 million millionaires in 2022. The main culprit? A weak stock market. The S&P 500 dropped by 19% that year. For a current pulse on how the wealthy are holding up, Bank of America released its August 2023 Consumer Checkpoint Survey. It found that high-income households have a weaker economic confidence and are more cautious on spending due to factors like soft wage growth and job creation for high earners, which may be tied to the rise in unemployment claims from the group.
There are some higher income households that their budgets are significantly stretched. They have leaned against credit to kind of bridge that gap. Household debt has gone up, in particular credit card debt.
Credit card debt has swelled to more than $1 trillion. Despite higher income households buying more discretionary items, this still points to another headwind for the wealthy.
When millionaires look at their risks right now, they mainly see the stock market because that's the source of their wealth.
Despite rallying in summer 2023, the stock market is now getting hit by surging bond yields and the prospect of higher interest rates for longer.
Some people say we could have a weak stock market for a long time because interest rates are so high. That would mean that there's not going to be much wealth creation may not be much wealth destruction, but unless you're adding wealth, unless you're growing millionaires, all those companies that survive based on rich people spending, whether it's luxury real estate, whether it's luxury fashion, whether it's boats, cars, planes, all those companies are going to see slower growth because they're all driven by the stock market. And it all depends what happens with that stock market in the next year. The second quarter for all the luxury companies saw something we hadn't seen at least since pre-pandemic, which was a decline in US sales. Not just slower growth, but an actual decline. LVMH, which is the giant, they always succeed. They actually reported a surprise 1% drop in US sales. No one expected that. That followed Richemont, which owns Cartier, lots of other brands, reporting a 4% drop in the US. So the top 20% of Americans by income account for over half the spending. I mean, we sort of know this, that the wealthy, those with the most money, spend the most. And they have, throughout the past 30 years, helped an economy where the middle class has lost ground.
The stickiness of inflation has even millionaires cutting back on spending for fine dining, luxury vehicles, and charitable donations.
Investors are dealing with two things, which is market uncertainty and low visibility. And by market uncertainty, what I mean is that because of market uncertainty for investors, it makes it difficult to invest because they don't know sort of where things are going, and that leads to low visibility.
Consumer spending is a huge driver of economic activity. So when the wealthy stop spending, it can slow the whole country's economic recovery.
They have to keep spending to keep the economy going, to keep the consumer economy going, to keep consumer companies profitable.
Around the world, though, the rich are expected to get richer. According to UBS's report projections, global wealth will rise by 38% over the next 5 years, reaching $629 trillion by 2027. And the number of millionaires is estimated to grow to 86 million, up from the 59 million in 2022. And a recession in the U.S., along with a potentially underperforming stock market, could create the right conditions for America's rich to bounce right back.
The wealthy right now, the mood is very grim because they see high inflation being very sticky and high interest rates sticking around for a long time, which means their stuff, their assets, are going to be worth less.
Worth households, they tend to have a larger percentage of their portfolio in cash. And a lot of that's just around wealth preservation. What you're going to see is more high net worth investors putting money into safe haven investments and just really biding their time. If the economy does slump, if we do end up in a recession, that those investors now have the dry powder to be able to buy other assets at distressed prices. There's an old expression that a recession is like a garage sale for the wealthy. That's the time where a lot of wealthy investors buy assets at distressed prices that can then ultimately grow their wealth over time as they rebound.